Hello, everybody. Thank you for joining us today. Appreciate you taking time out of your busy schedule to be with us and learn about a couple of very important topics. One, self-directing your retirement account, taking control of it, investing in what you know. And two, something that a lot of people feel like, including our guest speaker for sure, the ultimate investment that you can make. And we'll dig more into that for sure. Using your retirement account. Just while we're getting started here, a little bit of housekeeping. If somebody in the call could just put a thumbs up emoji in there and let me know that you can see and hear me and my screen okay. All right, thank you for doing that. Want to encourage everybody, we'll get started in about 60 seconds, but want to encourage everybody to ask some questions, put them in the chat, do it while you think of it, so you don't forget. We will give time, possibly throughout if it's relevant. I'll be monitoring the chat while our guest is speaking, but we will definitely give some dedicated time at the end to go through the Q&A systematically and make sure that you get all your questions answered. So please put your questions in the chat.
Make them too hard on me, all right?
Make them really hard for him. All right, we'll give it about 30 more seconds. We'll kick it off. Out of curiosity, if some of you would indulge me, type into I think you only have access to the Q&A, but that's okay. Type in where you're tuning in from, county, city, state, whatever you want to put.
It's like we got a heck of a crowd tonight as well.
Yes, sir. Denver, Colorado, Texas, Orange County, San Pedro, California, South Carolina, San Diego, Massachusetts. Oh, that's my buddy Keenaz. I hope I'm saying your name correctly, Keenaz. I know we've talked on the phone a few times. Good to see you. Houston, Randy, good to see you, my friend. Calabasas. There you go. And we are here in Orange County, California. Okay. Well, let me kick this off. Thank you, everybody, for that. Appreciate it. So I'm going to do just a brief intro on what we do here at Sense Financial. Then I'm going to get out of the way and I'm going to let our guest speaker do what he does and talk about what we call the investment solution for your self-directed retirement account. And yes, we are here today with a representative from Marshall Reddick. I will introduce shortly. And let me go through some of this first. First of all, my name is Brett Sininsky. I am a consultant at Sense Financial. We specialize in two products, the checkbook IRA and the solo 401k. And as we're going through this, I just want to make sure everybody understands that we are not fiduciaries. We're not providing legal or tax or investment or accounting advice. If you need such advice, please seek out the proper professional. This is for education only. Okay, so Sense Financial is a boutique financial firm that specializes, I like to say, a niche within a niche. We specialize in self-directed retirement accounts, and that's the niche. And then the niche within the niche is that they all have what's called checkbook control, which actually allows you to bypass or even eliminate the custodian when you're performing transactions and making investments. You can sign on behalf of the plan. It's a much more efficient way to invest your retirement funds than having to go through the custodian for everything. Less fees, actually no transaction fees with the checkbook setup. We've been in business since 2010. I like to say our clients love us because most of our business comes from referral, and most of those referrals come from our existing clients, and also from partners like our guest here today, CPAs, tax advisors, people who run syndication operators, and those sort of jobs all provide a pretty consistent referrals for us. But we do have 5-star reviews on the major websites you can think of: Google, Better Business Bureau, Yelp, Bigger Pockets, Trustpilot. By the way, if you haven't checked out Bigger Pockets, not everybody knows about it. Just a quick plug. They are like Facebook for real estate investors. It's forum based. You can ask questions. You can get involved in talking with different people. Highly recommend you check it out if you haven't. Biggerpockets.com. And to date, we have we're actually closer to 4,000 clients now, but almost 4,000 clients, and we've established well over 4,000 different self-directed retirement plans. since being in business. And I already said most of our clients come from referrals. So real quick, what are the benefits of the checkbook IRA and the solo 401k? Well, when you have money at a custodian like Fidelity, Schwab, T. Rowe Price, Vanguard, you are restricted to investing in what they offer. Okay. It's primarily stocks, bonds, mutual funds, and ETFs. What we do is we provide a vehicle, be it the IRA or the 401k, where we use a custodian, or we don't with the solo 401k, but with the IRA, we use a custodian that actually allows for alternative assets, stocks, in addition to stocks, bonds, mutual funds, and ETFs, real estate, crypto, precious metals. I have on the next slide a few examples of that. But the idea is it's not instead of, it's in addition to, and we want you to have true diversification. And there's really no way to do that with your retirement accounts without self-directing. And the returns are tax deferred in a traditional or tax-free in a Roth. We should all strive to have more money in Roth because that's tax-free ATM withdrawals down the road. And think about this as we're kind of talking through this. You can actually leverage your funds through with non-recourse financing. So if you put $10,000 in the S&P 500, unless you like trade options or do something like that. But if traditionally you're not getting a loan to buy more S&P 500, but if you want to buy a piece of real estate, you can actually, using a self-directed account, you can get a non-recourse loan and you can buy double or even more the amount of real estate you would otherwise be able to buy with just the cash inside the plan. So super cool thing that some people do. And then we talked about the checkbook control, and then the solo 401k, we like to call the ultimate retirement plan. It truly is. It truly is for a lot of reasons. First of all, literally 10 times the amount of annual contributions are allowed in the 401k over an IRA. If you're under 50, an IRA is $7,000. For the 401k, it's $77,000. So literally 10 times. Super cool product. Happy to talk through it more if anybody on the call wants to get on a call with us later. But I mentioned the unlimited investment options, real estate, commercial and residential, tax deeds, trust deeds. You can be the private lender. You can originate loans, or you can buy mortgages through a note broker. You can invest in a debt fund, and you can get a return, which is primarily what we're probably going to be talking quite a bit about today. And so you can kind of have a mix between more active investing, originating loans, versus more passive, where you invest with somebody who's already got some kind of operation that's going to give you a return, like a debt fund. You can do cryptocurrency, precious metals, almost the sky's the limit. In fact, the IRS only tells you what you can't invest in, and that's collectibles, stamps, baseball cards, wine, art, that sort of thing, and S corporation stock, because you have to be a person to be able to do that. And then in the IRA only, life insurance. And then there's some rules around prohibited transactions and disqualified parties with you and your immediate family. I'm not going to spend time on today. But again, the whole idea is diversification. I don't care if you have your money in, I shouldn't say it like that, but if you have your money in the stock market and you have some money in the S&P 500 and some money in Tesla, which you already have in the S&P 500 anyway, but you're diversified between mid-cap companies, large cap, small cap, whatever, you're still in the stock market. And at the end of the day, you don't have control over what those companies do, how they manage their businesses, and the returns that you get. You really don't. Can you look back on the history of whatever fund or company you're investing in since its inception and get a feel for what it's going to be moving forward? Sure, you can do that. However, we all know that historical data doesn't guarantee future results. It just gives you an idea, and you have no control. With self-directing, think about it like this. If you do a private loan, two people are signing on the dotted line, what the terms are, what the payment's going to be, what the interest rate. Is it going to be 2 points up front and a balloon in 6 months? Is it going to be, whatever, right? And you just cannot do that in the stock market. So as our guest is talking, who I'm going to introduce here in a moment, Just think about that. Think about what it would be like to take control of your retirement. And Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And some people say we're overdue. I don't like to say that because whatever. But the last time was probably COVID, and then, it kind of went back up. But 2008 and 9, a lot of you on the call here were around then. I owned some rental real estate back then, and it definitely dropped like a rock. And so, and so did the stock market, by the way. But if you diversify using self-directed, you can literally almost avoid those ups and downs and just kind of have maybe the ups, right? But not necessarily the downs. Of course, there's no guarantee. Every investment has risk, but you control it more with the self-directed account. Okay, I'm going to get out of the way now. Our guest speaker is Patrick Prunty. And in this session, he comes from Marshall Reddick Real Estate. And for those who may not be familiar, Marshall Reddick is a privately held real estate firm headquartered in beautiful Newport Beach, California, offering real estate brokerage and property management services, but also a firm that has a really unique private lending division, which makes common sense. Private loans designed for real estate investors. With that in mind, let me introduce Patrick Prunty, a true real estate professional who began a career at Marshall Reddick more than 20 years ago. His specialty lies in underwriting, analysis, and management of those private loans being originated at Marshall Reddick, and his experience is extensive. With more than 4,000 loans originated, today as Director of Private Lending, his focus is twofold. First is the oversight and management of his fully staffed private lending team housed in Newport Beach. And second is capital partner relations, business development, and the sustainable organic growth of the Marshall Reddick loan portfolio, which currently stands at $125 million. Oh, by the way, I'd also like to add, Patrick is one of the longest standing Sense Financial clients with an IRA LLC, as well as a solo 401k. Patrick, thank you very much. I'm going to stop sharing my screen so you can, but I'll let you take it away, my friend.
Oh, that was quite the introduction, Brett. Thank you. You're too kind. And thanks to everybody for joining. Give me a second here and get this screen set up for you so we can get started. Tons of information to go over, so much value, and I just appreciate the opportunity. Give me a thumbs up there, Brett, or crowd, if you can see. Perfect. Okay. So, again, it's just such a great opportunity to have. And I, as a longtime Sense Financial client, I'd really like to thank Brett. I'd really like to thank Dimitri and the entire Sense Financial team for everything that they do. They've been so good to me. They're my number one point of contact when I have any issue with my internal self-directed retirement accounts, but also for any of my clients. And I have a lot of clients who worked for Marshall Reddick a very long time. And, to have the comfortability of a vendor in the industry with whom you trust to be able to take that client is so important. It's so precious to me. So again, Brett and Dimitri, who's not with us tonight, again, thanks so much. I'd also like to thank each of you for the opportunity to be of service, right? From my perspective, it's a great honor and a privilege to help clients make money, especially when they're doing so lending money with me and Marshall Reddick, but also to do it safely. And of course, when it comes to a lot of us who are already self-directed retirement account owners, or those thinking about self-directing, you want to do it passively. And that's something that I have learned over all the years that I've been operating my self-directed retirement accounts. And at first, I didn't really realize, I'm not much of a stock mutual fund, that type. I've taken that on in my portfolio over time, but I didn't really realize the value in those types of investments. And And the reason I realize that now is because of the passivity, right? You're not having to rebalance your portfolio all the time. You're not worried about cash drag and some of these other things that become present when you have that self-directed retirement account. So I'm a firm believer in it, but you also have to find the right investment to be able to keep your capital working. And you have to be worried about safety, and you have to be worried about liquidity and a lot of these other things. So we're going to dive into a lot of that. So again, thank you for the opportunity. My name is Patrick. I've got my contact information on the screen here. Don't hesitate to reach out to me. Right, I'd love to speak to you, but I also have a really good team behind me. So there'll be people from my team reaching out. We'd love to have consultations. We'd love to help you understand a little bit better about what we do if for some reason it's not 100% clear as we move through this. So some of the topics of discussion today, we're going to get into my background. I think that's important to kind of understand how I approach things as a money manager today. I'd like to discuss my retirement accounts that Sense Financial has helped me set up and maintain. We'll talk a little bit about Marshall Reddick. That's the firm that I work with, and our relationship with Sense Financial, because it runs very deep. And then, of course, the topic of the hour, which is the investment solution for your self-directed retirement account. And love to answer any questions. I asked Brett if there's any that come in throughout. Feel free to stop me so that we can address those relevant questions right then and there. So whatever you want to call it, trust deeds, mortgages, notes, hard money, private money, sort of the buzzwords that are out there, and especially this newer one, secured private credit. That's one of the newest ones that I've heard. These to me are the absolute best mix of safety and yield coupled with liquidity. And it doesn't matter what type of economic times that you're living in. This is the investment that shines, right? It's really non-correlated to the overall market. And I think that, kind of the uncertainty of the times right now are a topic on everybody's mind. So I think when the market's good, trustees, mortgages, notes, hard money, etc., these things shine. When the market's not good, these things continue to shine. And I think they do so, especially with Marshall Reddick, considering the way we do things, which is going to be residential real estate only and first lien security only. I've got a couple goals for this discussion, and we don't have time to do an extreme deep dive, but we have to understand why secured private credit. We have to understand why Marshall Reddick, and we have to understand even the more of the niche. It's not just the secured private credit, but I think for a few specific reasons that the fund we operate is the best opportunity for those utilizing a self-directed retirement account. You can still use a self-directed retirement account to do the direct lending, but there are some major benefits offered by our fund, at least as it pertains to the use of investment with a self-directed retirement account. These are my top reasons. So there's no leverage. That's important for a number of reasons, but as it pertains to all of us here with those accounts, there's no UBTI. And if you don't know what UBTI is, definitely schedule a consultation with the Sense Financial team and dive into that, especially if you're using a self-directed retirement account that is backed by an actual IRA. I think there's some variations for the solo 401k, but the IRA can have some significant problems and some impacts when there is unrelated business taxable income present. The reinvestment option that is offered by our fund is an absolute game changer that helps avoid cash drag. Okay, and that's my third topic here is when making a lot of these other investments and having your self-directed retirement account, you have to be careful about having 100% of it working for you 24/7, 365. And again, as much as I'm a proponent of the self-directed retirement account, I have learned that our traditional retirement accounts that invest in stocks, bonds, and mutual funds, right, those don't have cash drag, right? You've got some kind of financial advisor or somebody, or it's just automatically reinvesting the dividends that you have, or you're buying more as you invest. But if you just let cash sit in the account uninvested, you're really doing a disservice to yourself and your retirement savings. So when it comes to our fund, you invest and you're earning every day until you choose to take the money out. And on that same note, it's actually passive. I can't tell you how many investments that I've made in my career, and just to find out that they're not as passive as one might tell you, or what you might read about on those forums on Bigger Pockets and things of that nature. When it comes to my career, rental property is one of those at the top of mind. And I'm a huge rental property proponent. It's a great investment, but it's very long-term and it is not passive. Okay. The idea of you having a tenant and never having maintenance vacancy and tenant problems and things, that just doesn't exist. So again, rental property is a good investment, but when it comes to the self-directed retirement account, for me, it's not the right investment because it's not as passive as I need it to be amidst my busy life where we all have family and jobs and things of that nature. Got to have the residential real estate as security. And when it comes to lending money, it's all about loan to value. The lower the loan to value, the lower the risk. So our fund offers a supreme loan to value benefit there at 65% or under since inception. And I think Brett alluded to the fact that prior history does not always predict future results, but it certainly makes me feel better. And so when it comes to our fund, I absolutely believe, and you can check our operating history, you should expect to earn 8.5% per annum for every year that you invest with us and that self-directed retirement account. I will add, you don't have to use a self-directed retirement account. You can invest with any type of vehicle you want, whether that's just in our lending department or whether it's in our lending department through our mortgage fund. Okay, my background, we'll make this brief, but I'm a Southern California kid. I grew up in San Diego. I played a ton of sports, and I really equate the sports that I played to who I have become. That teamwork and that ability to work amongst a team is just so key. But I moved up to LA, went to Long Beach State. I still live really close to the university. And that's where I got involved with Marshall Reddick as a college intern in 2003. And it's crazy to say, but I will celebrate a 22-year anniversary as a member of the Marshall Reddick team in June of 2025. So the time just flies when you're having a good time. I started in the accounting department, and that was really key to what I've done in my career as well. Really good understanding of financial statements, profit and loss, balance sheet, how that interacts. And that's helped me tremendously in my finance career and my approach when it comes to running our fund. The interesting thing too about Marshall Reddick is that we are just surrounded by real estate entrepreneurs. And so my entire career has been involved with all types of investments. It's helped me learn what I like and what I don't like. That could be wholesaling, flipping, long-term rental property. That could be land development. That could be private lending. I mean, there's so many different ways to get involved in real estate. 2008, I know we all haven't forgotten about that. I certainly have. It really hurt our business tremendously, but it shaped my life and my approach. And out of that recession came two amazingly awesome things. First and foremost is going to be the private lending division at Marshall Reddick. It didn't exist prior to the Great Recession of 2008, but also my first self-directed retirement account. And those are two amazing things that I look back and say to myself, wow, that was a painful time. It really taught me a lot, and I had two amazing things that came out of that. As it pertains to our lending division, I started this just organically. I was the first person making the loans. It was just us internally at Marshall Reddick making the handful of loans that we did in 2010, which is the first year of actual operation. But I built that brick by brick, and I continue to manage that lending division. As Brett alluded to earlier, we're just approaching 4,000 loan originations, and we have an extremely low default rate. 62 loans that have ended in a state of default, and I'm extremely proud of that. But when it comes to the type of lending that we do, it's all common sense. It's all low loan to value, right? And so we're making really good strategic decisions day in and day out. We're originating about 40 to 50 loans per month. That's a new loan, a new borrower. A lot of times it's a recurring borrower. It's a big value add to working with Marshall Reddick, is that we're a small firm. We're not one of those large hedge funds that has to lend a ton of money and is lending to whoever will take that loan. For us, we work with a lot of the same clients over and over, and we use our capital to support their ongoing real estate entrepreneurial business. I've got a team of 15 now. We're all housed in the Newport Beach office. So any of those that are local here in Southern California, if you'd like to come down and see us, we'd love to have lunch or coffee, show you the operation. And, we desire to have a relationship with you and to, really get to know our clients. And we really want you to know us. Okay. Brett also mentioned the 125 million under management. So it's not our first rodeo. But it is certainly enough for us to be dangerous, and we know what we're doing. 45% of that 125 million is in the hands of direct lenders. So those are the folks individually funding trust deeds or mortgages. And about 55% is in our mortgage fund, which is our aggregated approach to the same type of private lending that we do day in and day out. So that's just a little bit about me and about what we're doing. As far as my self-directed accounts, back in 2010, Dimitri and Sense Financial helped me set up a self-directed IRA LLC. I was originally a custodian with IRA Services, who's now Forge Trust. I imagine a lot of folks on the call are familiar with Forge Trust and maybe are using them as the custodian. But there's many, many custodians that are out there. In 2025, I've made a change. I still, of course, have the LLC, and it takes a while to wind out of that. But the new vehicle is the IRA Trust. So again, I'm doing exactly what Brett and Sense Financial talk about. I have that checkbook IRA. I'm using Solera now as the custodian as I wind away from the LLC and from the trust, and from the LLC and Forge Trust. In 2017, I had the opportunity, due to some self-employment income and some changes, I was able to set up a solo 401k. And that's an absolute game changer, as Brett alluded to. The opportunity to hide away, 10x what you can put into an IRA is a complete game changer for two reasons. Number one, again, a lot of uncertainty in economic times. Nothing makes me feel better than saving money. And the fact that I can put more than I can, I'm already maxing out my IRA. I'm already maxing out my Marshall Reddick 401k. The ability to put in that profit share element and get up into like the $50,000 that you're putting away into a retirement account every year, that just makes me feel fantastic, no matter what kind of times that we're operating in. And the second aspect of that is it's a huge tax benefit. Socking away that money, if you're doing it, of course, in a traditional style, the tax deferred style, is going to be a huge tax write-off to your business that you run. So if you don't have the solo 401k and you are self-employed, you must look at setting this up. And I recommend nobody other than the fantastic professionals at Sense Financial Services. So I've used these accounts to just do about everything you can think about. I mentioned wholesaling and flipping and building new construction and holding rentals. I've done all of that, literally thousands of transactions inside my two retirement accounts. And I've had the luxury of doing that, again, because of this employment that I've had with Marshall Reddick and just being surrounded by entrepreneurs that are doing everything you can imagine. A lot of stuff I wish I hadn't done. A lot of stuff I wish I'd done 10 times more. Okay. But you got to take strategic chances and educated risks and find out what it is you like and what you don't like and what works best for you and your self-directed retirement account. And I can't tell you how many folks I talk to that sort of have analysis paralysis or get petrified, and they set up these wonderful accounts and then don't mobilize. They don't invest. You have to do that. And I especially have a lot of clients rebalancing right now. I think a lot of folks have been in CDs, given, the interest rate hikes that were, can you believe it, 3 years ago in 2022. And then, of course, our banks all followed suit and started paying you 4 or 5% in your FDIC insured CD. Well, guess what? Those are all coming down now, and all your CDs are maturing. And so now folks are looking to rebalance, and it's like, what do I do? I'm telling you, for that self-directed retirement account, Marshall Reddick Mortgage Fund is something you need to look at. Okay. Well, the takeaway here is that I've learned a ton from my experience, and what I truly value is safety, consistency, passivity of the investment that I don't have to actively manage. We all need one less thing in our daily lives these days. I just can't believe how busy we are. I think technology is killing the world in a lot of aspects because we're trying to fit 10x more in every day than we used to a decade or two ago, before we had all this amazing technology and the social media and so on. So again, as we approach this, just understand that, you have a lot of options out there. I hope you'll give our options a look. But I am coming, and I'm not just telling you this, I'm saying this because of the experiences that I've had. And I'm a huge investor, not only on my own platform in terms of direct lending, but also in my mortgage fund, or in our mortgage fund. So I'll just briefly talk about Marshall Reddick. Brett already mentioned some of this stuff, but we do have 3 unique divisions. Real estate brokerage, we help people buy and sell homes. A lot of those are investment homes. We have a full service property management division. Okay. That doesn't matter whatever you need: leasing, rent collection, fix up on your property, tenant make readies, all that. And then of course this private lending division, right, that we're specifically talking about today. We've got 6 offices in 4 different states. That's California, Texas, Tennessee, and Florida. And note that our lending footprint is wider than those 4 states. But you will notice that we have an influx of the loans that we do revolving around these offices, where I have my own boots on the ground, my own Marshall Reddick employees operating in those locations where it's just a phone call away. We continue to grow. We've got 150 staff. A lot of that is in our brokerage and property management division, because as I mentioned, we're a lean and mean private lending team with a team of 15, all working out of our Newport Beach office here with me. Okay, private lending, all right? You're going to dive into the 2 sub-investment options that come from that. This is what we do. We do this only. We don't do anything else when it comes to private lending. It's non-owner occupied. It's short-term in nature. It's first lien only. There are other people out there doing seconds. I've done a second before, actually a few times. And guess what? I've gotten foreclosed on in second position. It's not a fun place to be. So I prefer to stay and play in the first lien position. Extremely good loan to values. We mentioned that, but that is going to be your risk, and analyst is going to be your loan versus the value of the collateral asset. These loans that we make are designed for the experienced and entrepreneurial real estate investor, and it has nothing to do with their credit or their credit profile. Okay. People borrow money from private institutions and portfolio lenders like Marshall Reddick for speed and customer service. Banks are slow. They got a lot of government guidelines that they've got to follow, and they just can't move at the speed in which real estate is changing hands today, especially for really smart entrepreneurial real estate investors who are finding off-market deals and or distressed sellers that need to close quick. We're in the residential space, and we absolutely love single family homes. You'll find most of the loans we make and the lion's share of our portfolio is in single family homes, the most easily valued, the most easily tradable asset in the event we find ourselves in a default situation. All of our loans are internally underwritten, and if we feel good about that loan, that collateral asset, that borrower, it fits our guidelines and we approve it, it will get posted on our marketplace. So we've created a marketplace on our website. And this is like the multiple listing service, except it's for loans underwritten and approved by Marshall Reddick. So if those of you who are into that technology, you can grab your mobile phone, and if you want to use that QR code, that will take you to the same location as that URL there at the bottom. That is where you will find our marketplace at MarshallReddick.com. Give a second here before we move on.
How did you get the little T-Rex in there? That's what I want to know. That's pretty cool.
So interesting, right? You think it's hard to get a QR code. With Google Chrome, you can create a QR code in literally 10 seconds. And the dinosaur T-Rex guy is a Google Chrome thing.
Gotcha. That's pretty cool.
Yeah. If anybody wants to do a webinar or a session on how to create a QR code, I'm a professional now. Anyways, this is what it will look like. Okay, this is what, if you were to use that QR code or go to that URL, this is what our marketplace looks like. And you're going to be able to see what types of loans not only are available for investment right now, but you're also going to be able to see our entire operating history, that 4,000 loans or so, if you want to get that granular on what Marshall Reddick has been doing in the private lending space over the last 15 years. Okay, as it pertains to you as the investor, you are the investor. You're looking for an investment option. I have the solution for you. You have two options to do it. I've already stated that from my perspective, the mortgage fund is the best when it comes to investing with the self-directed retirement account, but you have two options. And again, you can invest with cash outside of your retirement account if you want, but these are some of those non-traditional assets that are perfect for such self-directed accounts. So direct lending and Marshall Reddick Mortgage Fund. And I'm going to dive into each of those, pros and cons. So the introduction on the direct lending side, you choose the loan that you desire to fund, or multiple loans. Everybody's got a different capital stack, you choose. Or we shop them to you. A lot of our clients, just like on the borrow side, on the lender side, they recurring lending with us over and over and over and over again. So we start shopping loans to you as they become available, and we figure out what it is that you like. The marketplace, and as a direct lender, it's competitive, right? You're competing with other capital partners that are trying to swoop up these low risk, consistent, high yield investments, but you're also competing with the mortgage fund. Okay. But there is plenty to go around, right? We, again, are a small firm. I don't want to say we're boutique. I think we're a little bit bigger than that now, but we're certainly not BlackRock. In the direct lending, you earn 100% of the interest. We are not selling you a closed loan. You are the originating lender. Your name would be on the loan docs. You are the owner of that loan. You earn 100% of that loan. Marshall Reddick functions as the loan broker, and we will earn the origination fees paid by the borrower. There are some operational fees, right? There's a $350 funding fee that's paid to Marshall Reddick to participate and to be selected as the capital partner who will fund that loan. And then you've got third-party loan servicing. Those range in costs and obviously vary on the length of the loan term. There's a setup fee and then a monthly fee, but very, very, very low cost of doing business and as a capital partner in the direct lending. There's no fractionalization or crowdfunding, right? So with Marshall Reddick, it's one single lender on each loan. And that is something to consider as you compare it to Marshall Reddick Mortgage Fund. On every loan we do, it's the same way a bank would do it. It's third-party escrow, it's title insurance, it's loan servicing. These are things that are standard for each loan originated through our private lending program. There's no minimum investment per se on the direct lending, but it's a high investment threshold. Remember, it's one lender on one loan. So really, we're not getting into loan amounts lower than $75,000. I mean, maybe periodically there's one lower than that. And where a lot of times, to really get visibility, you need to have pretty significant amount in that self-directed retirement account. So when I say no crowdfunding or syndication, I'm not taking a $250,000 loan and partnering up 5 people at $50,000 a piece. That is just way too much work. It's way too much effort. And in the event you get that default, guess what? Now all 5 of you got to be on the same page, and that's just going to be a nightmare to deal with. The loan terms we focus on, 6 to 60 months in length. But we are really hyper focused on the 12-month loan term. That is going to be like 80-90% of the loans you'll find on our marketplace. But there are some longer terms and there are some shorter terms. When it comes to the exit, you do not have an option other than the borrower paying you off or the maturity on that loan. And please do not think that every loan stays until maturity and you just magically get paid off at the 365th day of a 12-month loan term. Right? The borrower is hustling to pay you off as fast as possible. The faster they pay you off, the less interest they owe you. Okay, so the average loan term we're looking at on our standard 12-month loan term is going to be 6 to 8 months. You expect to get your capital back. Okay, and that is one of the major downfalls, I would say, as it pertains to self-directed retirement account users and lenders, is that you've got to redeploy and redeploy and redeploy. It becomes an active business compared to the mortgage fund, where, you know what, you invest once and you keep as much capital or as little capital as you want in there, and it's earning 24/7, 365. You have to take the monthly payments. Again, that's really awesome for cash outside of a retirement account, right? Go spend the money on whatever you want to do. But if you do this with a retirement account, guess what? All those earnings have to go back into the retirement account. And unless you're fancy and you have some way and set up to dollar cost average those monthly coupons from the retirement account into something else, you're losing ability to earn on your earnings and compound. Again, another con when it comes to direct lending versus Marshall Reddick Mortgage Fund, as it specifically pertains to the self-directed retirement account investor. So understand that in the direct lending, Marshall Reddick handles all the origination duties. That's working with escrow, title, loan documents, you name it. Soup to nuts, however you want to refer to it. And we stay on throughout the term of the loan as the customer service agent. So if there are any issues, any late payments from the borrower, any issues with the servicer, Marshall Reddick is here to assist, and we would love to talk to you about any problems that you have. We don't have a lot of problems, but when we do, we are going to be here to help you. The loan servicer issues a 1099 for interest paid. You are earning straight interest. That's what you should expect from a tax perspective, or the nature of the income. That is irrelevant in a self-directed retirement account. It will just die there because, of course, you are working with a tax-deferred or a tax-free retirement account, depending on if you're traditional or Roth. Okay, so no tax issues. There is no UBTI. There is nothing of concern there. It's just a lot of folks doing this outside of a retirement account always want to know and ask that question. Okay, moving along to the mortgage fund, right? This is totally different, but investing in the same exact asset. This is a pooled approach, and we are set up and structured as a Reg D 506C private placement. Marshall Reddick and our team here is the managing entity, or the GP. This fund operates in perpetuity. There's no end to the capital raise and no end to the operation. The waterfall is extremely simple. We have a preferred return and a profit share. That is all. There are no load fees. If you choose to invest and say it's 100 grand, you get credit for 100 grand, right? We're not taking a piece of your investment and giving you credit, say, for 98,000 on 100,000 investment. The only fee that's there is going to be an asset management fee, pretty standard for debt funds like ours. That is an expense to the fund. And so when I quote returns for you, I'm quoting returns net of expenses, which includes the asset management fee. 100% of the net income every quarter. Yes, this is a quarterly distribution compared to a monthly. We're still collecting monthly from all the borrowers. The fund is, right? The fund as the lending entity. We're still collecting the payments monthly, but we're only aggregating all of the cash and the net profits and distributing those quarterly to our clientele. And I can tell you right here that we have about 100 self-directed retirement account investors out of a 335 total capital partners in this mortgage fund today. We are strictly funding fully underwritten approved loans through Marshall Reddick. That is the only thing that this fund does. That is the only thing this fund will ever do. It doesn't own real estate. It doesn't wholesale, flip, or do anything other than lend money to fully underwritten and approved loans originated by Marshall Reddick. As far as the basics here and kind of rounding this out, we do have a defined minimum. It's $25,000, strategically designed that way so that we can have, people get started, right? And a lot of people are investing and doing other things with their retirement account, and that's perfectly fine. But you might end up with like a lagging small balance, Maybe you have 25,000 or 35 or 50, and it's hard to get into another investment. Certainly that's not enough to go buy a piece of real estate. If you're one of those folks who wants to buy and own in a retirement account, look to the mortgage fund for that small amount. You can certainly add to your position over time. We have a lot of folks dropping in another 10, 15 here. Each additional contribution does not have to be 25,000. That is just the minimum capital account to get started. As I mentioned, the automatic reinvestment option is super key. It's just like a stock, bond, or a mutual fund, right? If you've got dividends on those in your regular retirement account, those are just getting added right in and then reinvested. Same option exists on our mortgage fund. So this is absolutely perfect for that retirement account. And as I mentioned, no UBTI, there's no leverage. A caveat here, you must be an accredited investor. I won't dive into that today, but that's not a big deal, right? That's a government mandated term that's not new. It's, out of the 70s and the SEC and all that kind of thing. Nature of the income is going to be a K1, as we are a California partnership, but again, no tax liability to those self-directed retirement account investors, right? It's either tax deferred for a traditional setup or tax-free for your Roth. Okay. Why private lending? Again, that new buzzword today, secured private credit. Safety, consistency, passivity, liquidity, and yield. Those are the bullet points, okay? When it comes to safety, you're backed by collateral. And for us, first lien residential real estate. That means in the worst case scenario, global financial meltdown, default on your loan, whatever you want to call it, right? The worst case scenario is you end up owning the collateral real estate. Could be way worse. And for me, and from my perspective, the question I have to ask myself every single time, and the question I train my underwriters to ask themselves every single time, are you okay owning that collateral real estate in the event of catastrophe? And if the answer is yes, well, you should feel really good about making that loan. Because when you factor in the borrower's down payment, if you did have to take it back, it's like buying real estate at a discount, a big significant discount. So as a real estate investor myself, rock on. Consistency, right? You collect the earnings regularly. That's monthly if you're doing the direct lending. That's quarterly if you're in the fund. Passive, right? Let's let somebody else do the heavy lifting. Direct lending, however, is much more active. Remember, if you're going to play in that short-term space, you're going to get your money back every 6 to 8 months. You're going to need to hustle to redeploy. If you don't, guess what? Cash drag, bringing your yield down. So on the direct lending, the note rates will be higher in terms of return than potentially the rate of return you're earning in the mortgage fund. But I find in my calculation, folks that are investing in the mortgage fund are actually earning more dollars because they're invested more days out of the year. Think about that. Liquidity. Much shorter investment outlook compared to other investments. And I'm a big rental property proponent. Rental property is like 10, 15, 20, 30-year investment. With both direct lending and the mortgage fund, extremely liquid investment. I happen to think the mortgage fund is more liquid. You have a 12-month minimum hold only. And then after that, it's like a month-to-month lease. You're not signing up for perpetual 12-month hold periods, right? You just take out your capital whenever you like, and we'd be happy to redeem it for you. Yield, of course, we all need to earn. And there's varying levels of yield, right? Make sure you don't compare our debt fund to like a real estate syndication where they're buying a 500-unit apartment building, right? Totally different risk profiles. As that syndication with that apartment building, guess what you're doing? You're playing equity and not debt, and you're second, maybe even third, subsequent to the debt that's already on the property. So if that promote fails and that deal doesn't work out, you stand to lose 100% of your investment. Hate to say that if you're in one of those real estate syndications. Now, if you have a good promoter, you can earn significant returns, 10, 20, 15, it ranges. High yields, high returns, but you have to take into consideration what your risk profile is. So when it comes to what we do, strictly debt, strictly 65% loan to value or under when it comes to our fund. And that's a great place to be when we're talking about yields between 8 to 13%. Why Marshall Reddick? Well, something I learned recently, and I'm looking at solar on my home, and I did a little Google. What questions should I ask the solar broker? First question on the list: how long have you been in business? And I was like, oh, that's a great question. So when it comes to Marshall Reddick, 1979, right? And when it comes to Patrick, know that you're working with somebody who's lives, breathes, sleeps real estate, and lives, breathes, and sleeps Marshall Reddick. We believe in customer service. I can't tell you how frustrated I get these days when I go to anybody's website. It doesn't matter if you're big, small, or other, and they hide the phone number. They're like, hey, talk to my chat bot. I don't want to talk to them. I want to talk to somebody who's going to give me an answer, and I want to talk to them right now. So when you work with Marshall Reddick, you're going to get somebody who calls you or answers the phone. Honesty, integrity, ethics are the pillars of the success at Marshall Reddick. And that is something that I bring to the table with my team every single day, something I'm extremely proud of. You know what you will get with us. We're well connected in the industry. We got connections all over the country. If that's realtors, property managers, escrow, title, insurance brokers, servicing, and specialty vendors like Sense Financial Services, 1031 exchange companies, DSTs, you name it. Our team is filled with knowledgeable and professional staff. And this is key too. When you're thinking about hiring your financial advisor, ask the question, are you investing in whatever stock, bond, or mutual fund is that you're asking me to invest in? When it comes to Marshall Reddick, I guarantee you, we've already talked about it for me, but every person on my team is funding loans on our platform, is putting money in the mortgage fund, is buying rental property. We do what we want you to do because we believe in it. So keep those questions in mind. As far as reviews go, right? Super important these days. Everyone's turning to online reviews. So check us out, right? Not every single review is a 5-star review. There are some negatives out there, but I think you'll find that the overwhelming majority of reviews that you'll find on Google, Yelp, Zillow, and any of the others are going to tell you a little bit about the character of the folks behind Marshall Reddick. Okay, rounding up, and we talked about these a bit earlier, right? Why the fund for your self-directed retirement account specifically? Again, residential real estate, low risk, 65 LTV. It's actually passive. There's so many investments out there that are ultra active, but you might think they're passive until you actually learn how to do them. That reinvestment option, don't forget. Right, with that direct lending, still a great thing. I have a lot of folks using their retirement accounts. Please feel free to do it. I believe in both tremendously. It's just you have to be more active and you have to get more creative and find a way to reinvest those monthly payments that you're getting back into that retirement account. Otherwise, again, you're losing the compounding and you're doing a disservice to your retirement savings. No cash drag. That's really important. We talked about that. No leverage. We talked about that. And hey, Dimitri is a big investor in my fund, right? So I know we all, like I do, hold Dimitri and Sense Financial really close to heart. He's a true professional and a really great person, as are all the folks like Brett and the folks at Sense Financial. So to me, that is saying something. Consistency will be the last one. And I'm sorry if this is a little bit small to see. I'd be happy to share any of this information on this discussion. But what I'm showing here is a graph on our fund since inception. This fund has been operational now more than 5 years. We're a quarterly distribution. So you have on your screen here 20 quarters since inception. We have been profitable and issued a distribution in each quarter. I firmly expect that to continue for the next 20 and the next 20 and the next 20 quarters after that. But this is to show the tight range. And again, prior history doesn't predict the future, but it makes me feel better. So the bar graph represents the total net earnings distributed every quarter and the breakdown between the portion the partner, the investor, is earning versus the portion that management is earning. So it's a really cool piece of data that I like to share with folks that are considering making an investment. Okay, as I mentioned, Marshall Reddick does a lot of things. If you're looking to just do a general consultation with us, there's your QR code, right? Speak with a professional, get to know what we do, ask any questions you want. There's no cost to this. There's no obligation to work with us. Just We hope that you'll do business with us. Specifically interested in our fund, start with this URL that I have here. We have set up a specific website amongst our MarshallReddick.com website. On this site, you will find the distribution history like I just showed. You'll find how much capital we have today, approaching $70 million. You'll find how many investors are working with us. You'll find one of the coolest things is a spatial map of the US, and it will pinpoint all. We have about 280 loans in that portfolio in the Marshall Reddick Mortgage Fund today. And you'll get to dive into like the location of each and every one of those loans. This website is updated in real time every time a loan of ours pays off, every time a loan is originated. So spend 15 to 20 minutes on that URL and you will be amazed at what you're able to learn. If you're ready to go and you want to take the next steps, but maybe have another question or two, you can schedule a consultation specific to the mortgage fund using that QR code. So as I mentioned, expect a follow-up call from somebody on our team. We'd love to talk to you, right? Whether it's about using your self-directed retirement account or other. And now I think pretty close to time. 5 or 10 minutes or so, Brett, if
yeah, all good. Hey, good job. Thank you so much for all that amazing information. Really appreciate it. I always learn something when I'm on these with you. So it was good stuff. We do have a few questions I'm gonna buzz through, but I want to get to yours. There's a couple that I will answer because they specifically relate to self-directed and this webinar. But the one for you is, when you said that being an accredited investor is no big deal nowadays, could you elaborate a bit more? And Gail is asking that question.
Sure. Yeah. I mean, a lot of folks that I talk to, they're unfamiliar with that term. So it sounds scary, right? This is not like a credential that you go out and get. This is not a class that you take, right? You are or you are not an accredited investor. And there's two ways to do that. There's either the income route, you're a high income earner, or the net worth route. On the income side, you need $200,000 of adjusted gross income in each of the 2 past tax years, and you qualify. No questions asked. If you don't have that, like my father, for example, who's retired and doesn't have income anymore, right? You can qualify with assets. So that's assets minus liabilities to get to net worth. So think brokerage accounts, bank accounts, rental property. Know that your primary residence, however, is off the table in that formula, and you just must prove that you have net worth greater than $1 million. So most folks in California, especially if you own a rental property, no problem doing that. And the accreditation can easily be done through like a CPA, financial advisor, attorney, or a third-party service. We recommend SenseFinancial.com, a small fee, and you can go through the accreditation. It takes like 24 hours.
Excellent. Thank you very much. We are 3 minutes till. I want to respect everybody's time, but Patrick, and your time as well. Are you available to keep going if we go a few minutes past 6?
No problem, right? This is a lovely opportunity to be with you guys. So ask away.
Perfect. Okay. So again, I'm trying to get to the questions that are specifically related to you. How do you decide to use a loan servicing firm versus Marshall Reddick doing the servicing? From Pay, P-A-Y. Pay is asking a question. Thank you.
Yeah. Marshall Reddick needs a license to officially service loans for a third party. Right? We have that license in California, but most of the loans we make are not collateralized against California properties. We are heavy in the Midwest and the South and whatever. So we cannot collect payments from the borrower and remit them to you, which is like the basics of loan servicing. And for those of you who know Marshall Reddick, for many years, we operated in this lending space with no third-party loan servicer. And we just stayed on as like the customer service agent, and the borrower was just paying the lender directly. Well, that's just not possible as we've tried to scale here. And so third-party loan servicing is absolutely mandatory. It shows the borrower the accounting, it shows the lender, the accounting on the loan. Everybody has a nice, neat portal. And look, loan servicing is property management for your loan. That's what it is. Okay. And we just need the borrower to have the ability to make a payment on their loan in any way they want. They need to make it by check. They need to make it by online bill payment. They need to make it by ACH. They need to make it by wire. If there's no loan servicer, you can't control all those different nuances of how the borrower needs to make their monthly payment. And in lending, look, if the borrower is ready to make a payment, you need to be ready to collect it. The servicer offers that.
There you go. Absolutely. I believe it also makes for a foreclosure process to be quite a bit easier, right? Because the servicer will handle that, correct?
You can do that. That's not how I would do it. That's not what I would recommend for Marshall Reddick clients. The servicer, right? Like we use FCI, for example. I mean, FCI services hundreds of thousands of loans, right? Marshall Reddick has 675 loans in its pipeline. So I would happen to believe that me and my team internally is going to be able to connect with the local state attorney if you needed to go through a foreclosure and help you project manage that foreclosure significantly faster than the loan servicer. For the layman out there who doesn't have 15 years of experience doing this like we do, certainly you can use the loan servicer and they would be happy to help you. And they know all those things that you don't know. I just think it's going to take you twice as long going through the servicer. They just don't have the bandwidth to do it as quickly as we do.
Got it. Good info. Thanks. Okay. Andrea's asking, so can we convert our solo K to a solo Roth, just like our traditional IRAs? I didn't know that. And I'll address that briefly. Yes, you can. First of all, solo 401k has a traditional bucket, but it also automatically has a Roth bucket as well. And so not only can you convert traditional money in the 401k to Roth 401k funds, but you can just make straight Roth contributions into the 401k. Okay, that $70,000 max can all be Roth. It can be all traditional, or it can be a combination of the two. And there's essentially three ways to get money in Roth. A straight Roth contribution, okay, dollar for dollar added to your taxable income, or a conversion of cash, dollar for dollar added to your taxable income, or a more advanced strategy that I don't have a lot of time to spend on today, where you convert a traditional asset to Roth. And when you get the valuation, AKA appraisal of that asset, depending on what it is, it can come in at a pretty significant discount. So your conversion of that asset from traditional to Roth can cost you a lot less in earned income than if you just do straight cash or straight Roth contribution. So thank you for that question, Andrea. Really appreciate it. And then there was another one here. The great Alex Pastel is asking a question. Alex, thanks for jumping on today, buddy. What would happen if I tried to open a self-directed IRA with one of the custodians you guys use, like Solera directly? What features would I lose out on that Sense Financial brings? I'm just curious. Oh, man, that's such a good question. First of all, Solera will not open a self-directed IRA for you without somebody like us. They won't do it. They don't offer that service. They act as a custodian, essentially by referral only. So if you go to Solera, like a lot of people do, because they have, they rank high on the website, on the search engines with self-directed accounts. So if you talk to them, they will refer you to a company like ours to set up your checkbook IRA. If you don't want to have the checkbook control, which we don't advocate necessarily, unless you're going to do like one transaction in 10 years. But if you're going to keep redeploying the money, you got to have the checkbook control, because going through that custodian for all those transactions is just going to be a big pain, red tape, extra transaction fees per asset fee, $400 per asset fee I've seen in some cases. And so it stacks up. Our annual fee is a flat $250. And then we have our establishment fee depending on what type of service you get. But there's no transaction fees. You might have some wire fees at the bank for wiring money. ACH is free if you get that set up, but no transaction fees. So you can do the full custodial basic IRA like I talk about with some of those firms. Solera will not do it. I'm not sure if Forge will. They might. I really don't know, but they're kind of antiquated and a little bit clunky, to be quite honest with you, as Patrick can probably attest to. And so better off having checkbook control. But I digress. Thank you for the question, Alex. I hope that answers it. And I'm going to give it like another 30 seconds here. I'm just going to kind of go. If somebody has a question, type it in. I should have said this at the beginning. My own personal experience with Marshall Reddick goes back to almost to when Patrick started there, but probably shortly after that, like in the mid 2000s, 4 or 5, somewhere around there. And my dad and I actually started going to their meetings and learning about buying investment real estate through the club, through the Marshall Reddick network. And they were essentially matching us up with agents and sellers in some cases throughout the country. And so I started buying investment real estate, just long-term buy and hold rentals. Like Pat said, 15 to 30 year kind of goals with these, right? And of course, the idea was that they were going to have, they were going to keep appreciating, and then we were going to 1031, and they were going to continue to have babies. And then of course, 2008 and 9 happened, and that all kind of went out the window. So, but nevertheless, I don't regret ever buying any of those. I learned a lot. I got tons of depreciation along the way with some bonus depreciation, paid almost nothing in my taxes on my W-2 earned income because of all the depreciation. It was a great experience. But I have personally, just like Dimitri, done quite a bit of business through Marshall Reddick as well. So I just wanted to share that. They're a great firm and well established. But looks like nobody else has any questions. Pat, I'll give you the last word, my friend.
Hey, like I said, this is a true privilege from my perspective. Thank you so much for your time, Brett. Appreciate it, man. You guys have any questions, don't hesitate. Love to speak to you. Have a great evening.
All right. Thanks so much. See you guys.